Institutional capital is flooding into European football. Global funds are aggressively acquiring historic sporting clubs and treating them like distressed corporate assets. The consensus underwriting model used by these multi-billion-dollar generalist funds is built on a miscalculation of operational risk. These allocators are targeting mid-tier clubs using a static margin expansion model. It is an approach that treats sporting performance as an independent variable. The primary catalyst for this trade is UEFA's financial sustainability regulations, which mandate strict caps on a club's squad spending. Investors assume that forcing payroll down to meet these regulatory caps creates a predictable path to a profitable exit. However, the specific operational mechanism used to cut costs destroys team cohesion. On the pitch, that loss of coordination triggers a slide toward relegation from the top leagues. Financial optimization and sporting survival are inextricably linked. In this industry, optimizing the balance sheet can natively cannibalize the club's ability to stay in the division. This valuation chasm defines the current market. On one side are the global giants, on the other, the domestic mid-tier. The elite clubs are trophy assets. They generate over 500 million euros in revenue, but trade at 4 to 6 times their enterprise value. Entering at a 5x multiple and exiting at 6x only yields a 6 to 7% net IRR. For large-cap private equity, that return profile is too low to clear institutional hurdle rates. High alpha opportunities reside in the mid-tier. These clubs are priced at a massive discount, often trading between 1 and 2 times revenue. But structural barriers are rapidly shrinking the pool of these discounted targets. In Germany, the Federal Cartel Office recently upheld the Bundesliga's 50+1 rule. This ruling protects the club member structure and blocks private equity from acquiring majority control. In England, the 2025 Football Governance Act establishes strict licensing and financial oversight. These regulations constrain the operational autonomy required for rapid private equity restructuring. When we funnel the market, we start with 96 clubs across Europe's Big 5 leagues. We subtract the 18 German clubs lost to ownership rules and 18 French clubs struggling with a broadcasting revenue collapse. After removing the clubs already backed by private equity or multi-club networks, we are left with only about 30 investable targets globally. With 12 major institutional vehicles chasing this same trade, the deal-to-buyer ratio is thin. Funds are aggressively underwriting much riskier assets. The financial logic for these deals is dictated by the regulations written here at UEFA headquarters. UEFA's financial sustainability regulations mandate a progressive step down in squad costs. The cap falls from 90% in 2023 to 80%, eventually hitting a permanent 70% ceiling. Private equity funds see that 30% gap as a mandated path to visible, predictable forward EBITDA margin. On a static spreadsheet, this cost-cutting creates a logical IRR projection. The model assumes an entry at 1.5 times revenue will bridge to a 3.5 times exit simply by achieving regulatory compliance. This assumes massive option value from the 25% increase in Champions League media rights coming in the 2027 cycle. It is a logical projection, but it only holds if the club survives in the top flight while aggressively rotating its squad. Split-second player coordination dictates survival on the pitch. Success depends on instincts built through thousands of hours of shared playing time. To hit that 70% spending cap, clubs must rotate the squad rapidly, swapping expensive veterans for cheaper, younger talent. A 2024 working paper by Kristina Lilova-Juhas analyzed 96 European clubs to measure the sporting cost of this turnover. This is network centrality. It maps player co-appearances to quantify team cohesion. Under private equity ownership, these connecting lines consistently shatter. The data shows that restructuring fractures these player networks, directly compromising performance in high-pressure away games. PE-backed male teams suffer a drop of 0.186 away goals per match. In female teams, the decline is even more dramatic, at 0.813 goals. Dropping goals leads to dropped points. For a mid-tier club, that performance decay pulls the team directly into the relegation zone. The cost-cutting mechanism engineered to protect the balance sheet actively dismantles the coordination structures required to stay in the league. This empirical decay is visible in the recent history of Italy's Hellas Verona. In January 2025, Presidio Investors acquired the club for an estimated 130 million euros. The deal was a textbook mid-tier buyout, executed with conservative leverage and a focus on operational efficiency. Presidio applied the standard playbook, rotating the squad to deleverage and hit the necessary financial parameters. Within 17 months of the acquisition, the squad cuts triggered an on-field collapse. In May 2026, Hellas Verona was relegated from Serie A. Relegation instantly vaporized the club's broadcast revenue. This pulled the enterprise value down to approximately 60 million euros. For the fund, a distressed exit at this valuation locks in a devastating negative 26.3%. First, we must watch UEFA's enforcement of the spending caps in the current 2025-26 cycle. If UEFA issues simple fines rather than sporting point deductions, the 70% cap is non-binding, and the EBITDA nominalization thesis breaks. Second, we require academic replication of the network centrality decay effect across multiple subsequent seasons. Until these variables are clear, any fund deploying capital into football without explicitly modeling relegation risk is printing fake alpha.